In this free video course, you will learn everything you need to know about market structure for trading stocks, forex, crypto, or any other financial market. By the end of this course, you will not only be able to trade market structure effectively, but you will also learn about multiple market structure techniques that most traders don't know about. Let's begin here by taking a look at what you can expect to learn from this course. And the very first thing we're going to take a look at is, of course, what is market structure? Because of course, in order to trade market structure effectively, we need to know what it is in the first place. And when it comes to market structure, this is actually often a misunderstood concept. Many traders will actually confuse market structure with something called price action. So it's very important to not skip over, chapter 1 here, unless you are certain that you really know what market structure is. In the next chapter, we are ready to take a look at some basic but very important market structure concepts. And the first thing we're gonna take a look at is something that is in the heart of market structure, and that is called the fundamental trend pattern. And included in this pattern are some concepts like structure, impulsive moves, and pullbacks. And the fundamental pattern is not only the foundation of classic market structure, but it's also in the heart of more complicated theories, like for example Elliott wave theory, Gann theory, and other theories. So to learn about the fundamental pattern is something we can't do without here. After that, we're going to take a look at multi-time frame analysis, or if you are more fancy, the word for this is fractal market structure. And please guys, don't be intimidated by complicated words and language. During this course, I will break everything down as simple as I can. So my goal is to just make everything as simple and understandable as possible. And learning about multi-time frame analysis here, or in other words, fractal market structure, is a very important concept that builds upon the fundamental pattern. So this is another thing. You do want to watch the chapters here in order, because each chapter will build upon the next one. The next concept we're going to take a look at is something called measured move objectives, or in other words, MMOs. And we will actually also take a quick look at Fibonacci here. These are two important concepts that can make our market structure trading much more effective. And after we have learned about these market structure concepts, it's finally time to start learn about trends and trend analysis. We're going to learn about uptrends, downtrends, and sideways markets. These are basically the three states a market can be in, and as a trader, it's important to understand these states to improve your probability of successful trading. After we have a basic understanding of the market states, it's time to dive a little bit deeper here. And two concepts we need to understand is something called change of character, or for short CHoCH, and break of structure, or for short BoS. In order to really master the uptrend, downtrend, and sideways market, these are concepts we need to understand. And after we have learned about the change of character and break of structure, it's time to take a look at something called internal and external structure. This chapter is related to the previous chapter, which in turn is related to the first chapter here. So I once again want to emphasize that I highly recommend to watch the chapters here in order. After this, it's time to take a look at something called strong and weak levels. So what makes a level strong here in the markets? When do we expect a level to break? When do we expect a level to hold? Another very important concept. And last guys, but definitely not least, we're going to take a look at a few entry models. So after we have a solid understanding about market structure, we need to learn about some strategies and techniques to know when to buy and when to sell. And here there are tons of different strategies, but in this course, I want to focus on two specific strategies here. The first one is a strategy called the failure test pattern, and this pattern actually have many names. It's also called the 2B pattern. If you have been reading about Wyckoff, it's sometimes called the Wyckoff spring or the Wyckoff Upthrust, but I really like this entry model here because it's actually pretty simple to use, and it also has some strict rules that can make it easy to follow here in a step-by-step manner. And the other strategy we're gonna take a look at is one of the, I would say, the most common trading strategy out there. It is the pullback pattern. However, this pattern, as with many things in technical analysis, I don't feel like it's well understood. We have different variations of the pullback. We have pullback holding and pullback breaking. So what I want to do here is to break down this pattern in a step-by-step manner, and you can actually even combine this pattern with the failure test here for potential better entries. But alright guys, these are the chapters we will cover. So now let's get started here and take a look at what is market structure. Just real quick before we continue here, I just want to give a big shout out and a big thank you to our channel members. You guys are the sponsor of today's video. If you want to support the channel while getting exclusive perks like custom emojis, priority reply to comments, being able to download the PowerPoints from the courses here on the channel, and even some exclusive educational videos, don't hesitate to become a channel member by clicking on the join button below this video. Once again, thank you all for the support, and now let's jump back into the course. Alright, so what is market structure? In very simple terms, I would explain market structure as a map of where the prices have been in the past. And what on earth do I mean by a map? Why is market structure a map? Well, just as a map shows how to navigate, for example, a city or a country, any kind of terrain, market structure shows us how to navigate and understand the market. In order to understand where you need to go and how to get there, it's a very good idea to have a map. And in order to understand where the market is likely to go next, it's also a good idea to have a map of the price, or in other words, market structure. And here, and this is very important, this is a super common, misunderstanding about market structure. Market structure is static while price action is dynamic. So what do I mean by this? Well, I like to explain the difference between market structure and price action by an analogy where you draw a line in sand, like this image right here. So just imagine that you are sort of drawing a line here in sand. In this analogy, the market structure would be the line here that is left behind when you use your finger. So for example, the highs right here and the lows right here are all part of the market structure. And this is what I mean when I say that market structure is static. The market structure doesn't actually change. Once the market structure has been built, it will stay there forever. But what about price action, and why is price action dynamic? Well, think about price action as how are you moving your hand? Are you moving your hand fast or slow, in a calm manner or aggressive manner, and so on and so on. So in very simple terms, we can think about price action as how is the price moving right now, while market structure is how has the price moved here in the past. And the cool thing about market structure is that if we study how the price has moved in the past, so for example, imagine that this image right here is how the price has moved in the past, this can actually give us clues about how the price will move here in the future. So for example, if you take a look at this sort of sand image right here, you can see that we have a high, we have a higher high, we have a low, we have a higher low. So isn't it, reasonably to expect that the hand will move perhaps something like this in the future. This is basically what we do with market structure. We look at how the price has moved in the past to predict, how the price might move in the future. And like with all technical analysis concepts, market structure can not predict 100%, what the price will do in the future. Just because the price or the hand has moved like this in the past, it doesn't mean that it cannot move like this here in the future. But we have to think, what is more likely? Is it likely that the hand will move like this in the future or continue here with the trend we already are in? Just to repeat here, we can use market structure to get clues about where the price is likely to go next. Alright, so now when we know about what market structure is, now it's time to take a look at the fundamental trend pattern. And one could argue that this pattern right here is the most important pattern in technical analysis. And when it comes to this pattern has many different names. I call it the fundamental trend pattern right here, but other traders will call it different things. It can be called the price pulse right here, and Tony Plummer has written quite extensively about this. He calls it the price pulse. So if you want to read more about this pattern, you can look up Tony Plummer here, but some traders also call it the basic pattern, some traders call it the ABC pattern, and so on and so on. So unfortunately this pattern has many different names, but the name here is not really important. The important thing is that we learn about the pattern and also learn about why this pattern is so important and fundamental. So this pattern right here basically describes how markets move. In very simple terms, markets tend to move like this. We have, first of all, a strong move either up or down. In this case, we have a move towards the upside, but the opposite is of course true for the downtrend. The bearish fundamental trend pattern looks something like this. But first of all, we have a strong move in one direction. After this move, we have a move in the other direction that is many times not as strong. This is basically like a period where the market cools down here a bit before the next strong move in the same direction as the first strong move. And these moves of course have names, and you might be familiar with these concepts. We call them impulsive moves and pullbacks. And the strong or sharp moves here are called the impulsive moves, or for short we can just call them an impulse. And the move here where the market cools down are the pullbacks. So we have impulse move, pullback, this right here is our next impulsive move, and so on and so on. And now you might of course wonder, why does markets move like this? Well, the explanation here is actually very complicated, because when it comes to markets, we have lots of market participants, we have buyers and sellers trading all the time. So it's actually very hard to explain this pattern, but in order to simplify as much as possible, I want you guys to think about this pattern from a perspective of just one trader. So let's say that you are a trader and you want to buy a lot of something. You have lots of money, you might be a bank or other financial institution. And now let's think, how would you execute a trade where you have to buy a lot? Well, one method you can use is to just buy everything at once. But if you simply buy everything at once and you have lots of money, this will usually lead to a very sharp price increase, which means that you will have to pay more than necessary for what you want to buy. If you want to buy something, it's pretty reasonable to assume that you want to get in at as cheap prices as possible. So another method to buy something rather than buying everything at once is to first buy a little bit, which will cause the price to move in one direction. However, after this initial buying spree, it can be a good idea to pause your buying for a while here and let the market absorb some of this upwards movement. For example, when a price moves a lot, like we saw right here, it's often the case that other traders in this market will take this as an opportunity to sell, and this will lead to selling pressure like we're seeing right here. So many times after a sharp move, the market will pull back a bit here and absorb a bit of this move. With that said, after the pullback, the price is once again lower and the trader can resume buying here and get in at slightly better prices. But of course, guys, as I said, this is a, super simplified explanation. And it's definitely not the whole picture of why this pattern appears. But I hope that this explanation at least gave you guys a little bit of intuitive understanding, of the psychology behind this pattern. And of course, when we connect multiple of these patterns together, we will actually have a trend. But now, let's actually dive a little bit deeper here and take a look at multi-time frame analysis. And the very first thing we need to learn here is that the fundamental trend pattern can be found on all time frames. So as you guys can see right here, we have a fundamental trend pattern. But what you also can see is that within this pattern, or to be more precise, within the first impulsive move, we actually have another fundamental trend pattern on the lower time frame. So let's, for example, imagine that this black fundamental pattern is, a high time frame. Let's, for example, imagine that this right here is the daily time frame. Then this red fundamental pattern would be perhaps on the 1 hour time frame. So while impulsive moves or pullbacks might look like straight lines on the high time frame, if you zoom in a lot, you will see that these impulsive moves and pullbacks will actually be trends on the shorter time frames. And a very important conclusion we can draw from this is that other patterns and structures can be found on all time frames as well. So, for example, when it comes to pullbacks, like right here, we have tons of different variations of pullbacks. We have, for example, flags, pennants, and wedges, which are different chart patterns that represent pullbacks. So let's imagine that this pullback right here was looking like a wedge. A wedge is basically like a falling triangle here where the range gets tighter and tighter. So let's say that this pullback right here was a wedge. By understanding that the fundamental trend pattern can be found on all time frames, we can also understand that wedges can be found on all time frames, because this red pullback right here could of course also be a wedge, right? And let's actually imagine right now that we zoom in even further. So the red line here, remember, was a 1 hour time frame, but let's say that we zoom into maybe, the 5-minute time frame or something. You'll notice that this impulsive move of the red line right here can actually also be a fundamental trend pattern. And for example, this pullback right here could, for example, also be a wedge. So I hope by this example, you can see here that because the fundamental pattern can appear on all time frames, this basically means that technical analysis concepts can be applied to pretty much all time frames as well. So the conclusion from this is that markets are fractal. And fractal right here is simply a fancy word for saying that parts of a pattern looks the same as the whole pattern. Alright, so now it's time to dive deep here into impulsive moves. And in very simple terms, an impulsive move is when the price makes a strong or sharp move in one direction. So for example, if we take a look at this chart right here, you can see that this move right here is a strong and sharp move towards the upside. So this right here is an impulsive move, or for short, impulse. And right here, we can see yet another. This was a very, very strong move. You can see lots of large body green candles. So another clear example of an impulsive move. But now, to say that impulsive moves are, strong moves or sharp moves in one direction, that might not be of a lot of help. So now I want to show you guys some specific rules and signs you can look out for to determine if we have an impulsive move or not. And the first thing to look out for, or at least the first thing I look out for here, is that I'm looking out for momentum candles. And in simple terms, momentum candles are candles with large bodies. For example, if we take a look at this first impulsive move right here, we can see that we have multiple candles here with large real bodies. For example, right here, a pretty large real body, large real body, large real body, large real body, and so on and so on. So when I look out for impulsive moves, I'm looking out for large real bodies. And here you might wonder, you know, how do we know if a body is large or not? Well, what we simply have to do here is that we have to compare the length of the bodies here, you know, compared to the previous candles. Unfortunately, in this example, I had to cut it out right here. But in order to determine if a body is large or not, we want to compare it with the previous bodies. What I usually do here is that in order for us to have a momentum candle, I want the candle to preferably be, you know, at least twice as large compared to the previous candles. The other thing I look out for here when I look out for impulsive moves is that we want to see mostly candles of one color. So when we have an impulsive move towards the upside, we're looking out for mostly green candles. And when we are looking out for an impulsive move to the downside, we're looking out for mostly red candles right here. So for example, on this impulsive move, you can see that we pretty much only had green candles. We had one small red candle right here, but we definitely had mostly green ones. The final sign I'm looking out for here is that I'm looking out for candle closes near the highs or lows of the move. So when it comes to impulsive moves towards the upside, we want preferably the candles to close here near the high. So for example, you know, in this case, we can see that many of these candles closes very near the high of the candles. This one had a slight upper wick here. And even, for example, you see this candle right here that was a red candle. Even this candle actually closed here near the high. So that is a good sign. And if we take a look at this other impulsive move right here, we can see that, you know, pretty much all of these candles closed very near the highest point of the candle. And by using these rules, we can also see why this right here was not an impulsive move, right? First of all, this move did not have momentum candles. You can see the bodies of all of these candles was very tiny here. You can also see that in this move, the candles were not mostly one color. You can see we have a mix here between, you know, red candles and green candles. And last but not least, you can see that the candle closes here was not near the highs of this move. You can see we had many wicks here, and many of these candles actually closed near the low. So now it's time to dive deep into pullbacks. Or another word for this is retracements, another word is consolidations, but all of these words pretty much mean the same thing. So what is a pullback? Well, a pullback is a temporary reversal that goes against the direction of the current trend. So if we look at this image right here, we can see that we had an impulsive move, a move that goes in the same direction of the trend. Then right here, we saw a brief pause in the trend. This right here is our pullback. It's our temporary reversal that goes against the direction of the current trend. But now, to simply say that a pullback is a temporary reversal might not be too helpful. So now let's once again take a look at some specific rules and signs to look out for to spot pullbacks. The first thing I'm looking out for in a pullback is that I want to see relatively small candles. So I want to see the bodies here to be pretty small compared to the impulsive move. So if we once again look at this image, we can see that this right here is the impulsive move. In this move, we have multiple candles with, you know, large real bodies. So what I want to see here in the pullback is that the bodies here of the candles should be pretty small when we compare it to the candles of the impulsive move. And in this case, we can indeed see that the candles here in the pullback are much smaller compared to the impulsive move. So this is a good sign that we're talking about a pullback. The next sign I'm looking out for here is that in pullbacks, we often have mixed colors. So we often have both green and red candles. And once again, if we look at this pullback right here, you can see that we have both multiple green candles, right, and multiple red candles as well. So this is once again a good sign of a pullback. Last but definitely not least, in pullbacks, we will often see multiple wicks present. And in this pullback, we see that multiple of these candles have, you know, both large upper and lower wicks. You can see this first candle had wicks, this one as well. This candle, large wicks, large wicks, large wicks. And to be more precise here, what I'm looking out for here is that I'm looking out for multiple wicks and also large wicks compared to the real bodies. And when it comes to pullbacks, we have basically two different versions of pullbacks that we need to know about. Pullbacks can be simple, but they can also be complex. The simple pullback, which you can see right here, is, you know, very simple. It's basically when we have an impulsive move that goes up like this, then the actual pullback looks pretty much like a straight line before we see the next impulsive move. So this image at the top here is an example of a simple pullback. We have an impulsive move that pretty much goes up in a line. We have a nice pullback here, and then the next impulsive move. With that said, pullbacks can also be complex, and these pullbacks can be much harder to spot. It can take some time to learn them, and the reason that makes them so hard to spot here is because the actual pullback, which you can see right here, has highs and lows within the pullback. So if you take a look here at the complex pullback, you can see that we actually have a sort of minor high and another lower minor high within the pullback. We also have like a low here and another low here within the pullback. So we pretty much have like a small downtrend here in the actual pullback itself. So just to repeat here, a simple pullback has one counter trend move, so one move that goes against the direction of the trend, while the complex pullback here has two or even more counter trend moves. So a complex pullback could even look something like this, where we have like a structure here with multiple counter trend moves. And if this sounds complicated right now, don't worry, because as this course goes on, you will learn about tools and concepts that will help you understand and even trade complex pullbacks. And while the complex pullback is hard to learn, when you actually learn to trade complex pullbacks, they can be very rewarding. Alright then, so now let's actually switch the attention here and take a look at a tool called Fibonacci Retracement. And more specifically, let's take a look at how this tool relates to market structure. And for this chapter, I will be using TradingView. This is the platform I use for all my analysis and pretty much all things trading. And if you haven't signed up to TradingView yet, don't hesitate to check out the link in the description or the pinned comment for a free 30-day trial and a $15 bonus if you ever decide to upgrade your plan. But now, to show you guys how the Fibonacci retracement works, I think it's easiest to just show you guys the indicator right away. So what we want to do here is that we want to go up here where it says GAN and Fibonacci tools. We want to press here, and then we want to go down and press on Fib retracement. And for now, let's just drag out the tool on a blank chart. To do this, you basically click on one point on the chart, you drag it up, and then you click again. And now, as you can see here, multiple numbers and lines will appear here on the chart. And the first thing we have to understand is, what does all of these numbers actually mean? Well, these numbers right here are basically percentages. So for example, right here it says 0 and it basically stands for 0%. Right here you can see that it says 0.236 and this basically means 23.6%. For example, right here we have 0.382 2, and this basically means 38.2%, and so on and so on. So these numbers you can see on the Fibonacci tool are just percentages. But now let's go back here to the fundamental trend pattern and take a look at what these percentages actually mean. So let's once again make sure that we select the Fibonacci tool. And first of all, to draw your Fibonacci retracement, what you want to do is that you want to start the Fibonacci retracement at the low of an impulsive move. And remember, where's the impulsive move? Well, it starts right here, and the impulsive move ends up here. Then you simply want to drag out the tool here to the right. And what the Fibonacci retracement basically measures is how deep is the pullback compared to the impulsive move. So as you can see, the impulsive move goes all the way from 0 to 1 here. So the impulsive move is 100% right. But the retracement tool is used to measure how deep the pullback is. And you can see in this case, the pullback goes all the way down here to 0.618. So in this case, the pullback is 61.8% of the impulsive move. And in very simple terms, the most common area for the price to reverse, or in other words, for the pullback to end here, is this area in between 0.382 to 0.618. So it is this area between around 38% to 62%. And in this course, we don't really have time to dive super deep into Fibonacci retracements. But if you want to dive deeper, I actually have a full course on the Fibonacci tool. So if you have the time after this video, I highly recommend to check that course out. I will make sure to link the course somewhere up here in the corner of this video. But as I said, for now, all you need to know is that the price tends to reverse in this area. And now you may of course wonder, how do we use this tool? Why is this tool useful? Well, let's say that we are here, let's say that we have an impulsive move and the price start to pull back here. This right here is the point where you can use your Fibonacci tool. You can drag it up here, you can start to drag it to the right. And now, once the price have started to pull back here, most of the times we will pull back here to around this area. So this right here is a point where we can look out for price action signals indicating a reversal to the upside. But alright, so now when we have a very basic understanding of the Fibonacci tool, I also want to take a quick look at something called the measured move objective, or for short, MMO. And while the Fibonacci tool gives us an indication about how deep the pullback is, the measured move objective gives us an indication about how large the next impulsive move will be. And this principle right here is actually super simple, and it's used in many technical analysis concepts such as chart patterns, pullback trading strategies, and so on and so on. And what the measure move basically tells us is that the impulsive moves in a trend, so this move and the next impulsive move right here, tends to be around the same length. They will definitely not always be the same length, but in a trend, in order to maintain the trend, the impulsive moves should be around the same length. So the tool we want to use here is that we want to go down here where it says geometric shapes, or this is at least the tool I use. Then I go down here and press on the rectangle tool. So what you basically do here is that you measure the impulsive move. So you go, just as with the Fibonacci, you go from the low of the impulsive move to the high of the impulsive move. Then you click on this one, you click Ctrl V and Ctrl C to copy it, and then you measure here from the low of the move. So in this case, you can see that the impulsive move here are the same length. And this method right here is most commonly used to find the target levels. So for example, let's say that we have a chart pattern that looks something like this. This right here is what we call a bullish flag. And let me mark this pattern here Let me change the color here to red so you can see clearly. A bullish flag is basically an example of a complex pullback. So we have the impulsive move right here. Then the actual flag here is a complex pullback. And a common trading strategy is to either enter when the price breaks above the resistance right here, or trying to enter here at the support of the flag. But how we use the measure move right here is basically after our entry, we expect the price, remember, we expect the price, let's measure the impulsive move. We take this exact measurement and then we measure here from the low of the pattern. So in this case, we expect the price to reach somewhere up here. So using the measure move in order to take targets is a very common method. All right then, so now the time has come to take a look at something called trend analysis. And first of all, in very simple terms, the market can basically be in 3 different states. First of all, we have the uptrend. And an uptrend is basically a market state where the price continues to print both higher highs and higher lows. So for example, on this chart right here, you can see that the price printed a high right here. Then the price went down here and printed a low. We saw a pullback and printed a low. But next, the price pushed higher and printed another high, or in other words, a higher high. And then it went down and printed a higher low. And the market is basically in an uptrend as long as we continue to print higher highs and higher lows. So for example, right here, you can see that we have yet another higher high, right? And here we have yet another higher low. Once again, right here, we have yet another higher high. So here I can actually see that I actually made a mistake. This part right here should have actually also been green, because as long as we are printing consecutive higher highs and higher lows, the market is in an uptrend. The next market state is the downtrend. And the downtrend is just the opposite of the uptrend. Or in other words, we need to print consecutive lower lows and higher lows at the same time. So for example, here we have a low, here we have a high, here we have a lower low, right? And here we have a lower high, lower low, and so on, lower high. So the red part here is a downtrend. The final market state here is what we call a sideways market or consolidation. And this market state is simply when we don't have an uptrend or downtrend, all other market states are considered, some kind of sideways market. So for example, right here, you can see that we have highs. Here we have a higher high, but then a lower high, then a higher high. Here we have lows, at around the same level. So in this market state right here, we don't really have a trend. So this is what we call a sideways market. But there are multiple types of sideways markets, and we're not going to talk about all of them in this course. But you can, for example, imagine, a market where we have a low and a high that goes something like this. You can see in this case, the market is printing both lower lows and, higher highs at the same time. So this is yet another example of a sideways market, because even though we are printing higher highs, in order to have an uptrend, we also need to print higher lows. And that's not true for this market. And even though we're printing lower lows, in order to have a downtrend, we need to also print lower highs. So this is an example of a sideways market. We could also imagine a market that maybe looks the opposite, so a market that looks something like this, where we are printing consecutive you can see consecutive lower highs and at the same time consecutive higher lows. This is also a type of sideways market. Alright, so now when we know about the very basics of trend analysis, we know about the different market states. Now we are ready to dive deeper and take a look at some specific rules we can use to determine the direction of the market. So now guys, it's finally time to take a look at 2 very important concepts, and I'm talking about change of character, or for short, CHoCH, and break of structure, or for short, BoS. So first of all, a break of structure occurs when we break to a new high in an uptrend or break to a new low in a downtrend. So if you, for example, take a look at this market right here, you can see that this market breaks to a new higher high when we break this point right here. So this specific break is what we call a break of structure. And when we break to the upside in an uptrend, we call this a bullish break of structure. And as you can see right here, we have another example of a bullish break of structure. Why is this a bullish break of structure? Well, at this point right here, this market breaks to a new high in an uptrend. So this right here is yet another BoS. But what about the change of character? Well, a change of character is when the price fails to maintain lows in an uptrend or fails to maintain highs in a downtrend. And if this sounds complicated, I think it's much, easier to show this. So for example, if you take a look right here, you can see that we have a low. And remember, in order to maintain the uptrend, we need to print both higher highs and higher lows. But at this point right here, you can see that the price actually breaks below the low. So at this point, the price is no longer in an uptrend because this uptrend failed to maintain the low. So this right here is what we refer to as a change of character. And since we break to the downside, this is what is called a bearish change of character. But what about this break right here? Well, now we are in a downtrend, and when the price breaks to a new low in a downtrend, remember what we have? Well, this is a break of structure, right? In this case, it's a bearish break of structure because we are in a downtrend. Once again, what about the next break? Well, here the price once again breaks to a new low, and since we break to a new low in a downtrend, this right here is another bearish break of structure. But now then, what about this break right here? Is this right here a break of structure or is it a change of character? Well, remember here, in order to maintain this downtrend we are currently in, the price needs to hold this high right here. So it's actually not until this break right here we see the bullish change of character, right? The other break down here did not break the last high of the uptrend. So this break doesn't change the character of the trend. However, and this is very important, this right here, when we zoom in to lower time frames, is something we call a minor break of structure, or in other words, an internal break of structure. Because remember from earlier in the course, remember when we talked about the fundamental trend pattern, all market states, so uptrends, downtrends, and sideways markets, can be found on all time frames. So while we have break of structures and change of characters on one time frame, when we zoom in, we will see that we will find many kinds of trends and many kinds of breaks on the shorter term time frames as well. And this is exactly what we're gonna look at next. So now guys, it's time to dive even deeper and take a look at internal and external break of structure and change of character. And if you think this right here looks complicated, don't worry, I will try my very best to break this down in a very simple manner. So here, the first thing we need to understand about this chart is that right now we're looking at two time frames at the same time. And the black line right here is the high time frame. So you can, for example, imagine that this right here is a daily chart, while the red chart right here is the low time frame. So if the high time frame is the daily chart, perhaps the red chart right here is a 1 hour time frame. So you can imagine that we're right now looking at a daily time frame and a 1 hour time frame at the same time. And now, and this is very important, we have, as I said, external and internal break of structure and change of character. And the external break of structure and change of character are high time frame breaks. while the internal break of structure and change of character are low time frame breaks. And here, just because we're looking at 2 time frames at the same time, we really need to not overcomplicate things. The principles here are the exact same as what we talked about earlier in the course. So remember, the external breaks are still the exact same thing. So for example, right here, just as we talked about before, this is our break of structure. But now, because we're looking at 2 time frames at the same time, we can write an E here before to just mark that this is our external break of structure. And remember, the next break of structure was right here. So here we have another external break of structure. And just as before, right here, remember we had our change of character. So now we can write this out as our external change of character. But now, since we're looking at 2 time frames, we will also have internal breaks. So for example, right here, what is this? Well, since the 1 hour chart is currently in an uptrend, and when we break to a new high, this right here is a break of structure, right? And because this is on the low time frame, we call this an internal break of structure. Right here, the price once again breaks to a new high. So we have another internal break of structure. Here we once again print a higher low, but the move from this low actually fails to break this high right here, and we print a lower high. But remember here that it's not until we break this last low of the downtrend, so it's not until we break this point right here, we actually get our change of character, right? And since this is on the low time frame, we call this an internal change of character. So this break right here actually indicates that on the short-term time frame, the price have shifted from an uptrend to a downtrend. And when the price shifts to a downtrend in the short term, this is actually an indication that we're talking about a pullback here on the high time frame. So by more closely analyzing the trend on the short-term time frame, we can get early indications of when the pullback on the high time frame starts, and we can use this knowledge to take better trading decisions, and as a result make more money. Alright, so now we're ready to take a look at 2 more important concepts we need to learn about, and that is strong and weak price levels. And this concept right here is pretty similar, but let's go over it quickly. A strong level is a level that comes from a move that breaks structure. And at this point in the course, you can hopefully identify the break of structure. So for example, remember right here, we have a break of structure, right? Because we break to a new high in an uptrend. And what do I mean by a level that comes from the move that breaks structure? Well, here we need to take a look at, okay, so we break the structure right here. What is the move that caused this break of structure? Well, we trace back here and we can see that the move that broke the structure started right here. So this right here is a strong level. And another name for this is to call it a strong low. Once again, right here, we have another break of structure. The actual break occurred right here. And where did the move that broke structure start? Well, it started right here. So here we have another strong level. But what about the opposite? Well, a weak level comes from a move that fails to break structure. So now let's focus on the move that started right here. In order for this move to break structure, or in other words, to, change the character of this trend to a downtrend, the low this move needs to break is actually this low right here. Because if the price managed to go down and push all the way down below that level, we are breaking the structure of the uptrend here. And because this level failed to do so, this right here is actually a weak level. But what about the next move? What about the move that started right here? Well, in order for this to be a strong level, we need to break below this point right here, right? So if we extend this level, we can actually see that right here, the price succeeded to break below. So this right here is actually a strong level. What about this move that goes from here to up here? Well, in order to break structure, we need to push above, all the way above this point. So this right here is actually a weak level. By the way, as I mentioned earlier, sometimes the levels here that are highs are also called weak highs, or, you know, strong highs. And the same thing is true with the lows. We can do one last example. The next move is this strong or weak. Well, this right here is a strong level. Why? Well, because we managed to break structure right here. All right, guys, so now it's time to take a look at our first entry model. And the first pattern we're going to take a look at is called the failure test pattern, or 2B pattern. This pattern has even more names, but I first, you know, read about the pattern in this book, The Art and Science of Technical Analysis, written by Adam Grimes. I actually highly recommend that book. But before we dive into the charts here, let's just do a quick overview of the pattern. The failure test pattern is a short-term reversal pattern where the price briefly breaks either support or resistance and then quickly reverses. And one thing I really like about this pattern is that it's actually very simple. It's a simple pattern, and it also has clear rules, at least for the stop loss placement. So for all trades, we want to have a stop loss and we want to have a target. And when it comes to the stop loss placement for this pattern, it's not really up to debate. There's pretty much only one place where you can set your stop loss. When it comes to the target level, we do have a few different options that will depend on your trading style, but I will show you guys some different target methods for this pattern as well. And as I said, this pattern actually have many different names, and it has been around for a long time. It can be called the 2B pattern, and if I'm not wrong, this name was popularized by a trader called Victor Sperandeo. But we can actually also call this pattern a Wyckoff spring in the case when the pattern is bullish, and a Wyckoff upthrust when the pattern is bearish. So all of these different patterns, the upthrust, spring, 2B pattern, failure test pattern, they have slight variations, but to be honest, they are all pretty much the same pattern. So if you learn the general rules about this pattern, you don't really have to worry about the name. The name is not important. What is important is that we understand the actual pattern. And here, and this is very important, we can of course combine the pattern with market structure to increase the probability of success. As you guys know, no pattern will work all the time, but what we as traders can do is that we can try to increase the probability of success, and as a result, our probability of being consistently profitable. Alright guys, so now let's jump back into TradingView here. I'm currently looking at Euro US dollar on the 15-minute time frame. I know a lot of you guys are often asking, you know, what time frame am I looking at and what am I trading? But it's not really important. You can use the failure test pattern in the short-term time frame, like for example the 15 minutes, but you can also use it on larger time frames as well. But now, what about this pattern? Let's take a look at the pattern here. Well, the first thing we can notice about this chart by just briefly looking at the chart is that we are in an uptrend, right? We're printing, you know, higher highs and higher lows. So by first glance, we can see that we are in an uptrend. So here we're looking out for bullish trades. We're looking out to trade in the same direction as the trend. But here we can also do our analysis when it comes to break of structure and change of character in order to really know that we are in an uptrend. So for example, we can see that we have a high right here, we have a low. When we break the high, remember, here we have our first, you know, break of structure, right? Then we saw our impulsive move, we printed a new high right here. So now this right here is the high the price needs to break in order to, you know, continue the uptrend. You can see that we had a small break right here. We pushed up and printed a new high right here. So now this right here is the level we need to break in order to continue the uptrend. We also, of course, had a low right here. Then we had a higher low. So with this green candle, you can see that we had another break of structure. After this, the price came down here and printed a low. And here is when it gets really interesting. You can see that we saw this strong impulsive move towards the upside, but then we actually saw a very strong move towards the downside. And let me actually delete all this stuff right here, because now you can see, remember that this right here is now the low the price needs to break in order to create a change of character. So let's actually draw out a level right here. And here you can see that the price quickly dipped below the level that leads to a change of character, but then quickly reversed. And here, this is actually an important concept that I haven't mentioned yet. In order to create a real change of character, what I'm looking out for here is that I need a candle close below this level. So if we get a strong candle close below this level, this is what confirms a change of character, at least in my opinion. You know, as with all technical analysis, some discretion will be involved, and some traders actually see wicks as breaks. I personally only see candle closes as breaks here, because these wicks below key levels can actually be great buying opportunities. And the trigger for this pattern is to enter here on the candle close on the candle that just quickly dipped below and then pushed above the support. But what about the stop loss level and the target level? Well, when it comes to stop losses, as I already mentioned, the stop loss for this pattern is very straightforward. We want to place the stop loss below the wick of the candle. So we want to place the stop loss below this point right here. And I also usually leave some wiggle room here. And you may wonder, why do we want to set the stop loss below this point? Well, if the price falls below this point right here, and especially if we get a candle close below this point right here, then, as you know, we have a change of character. And in this case, the trade no longer favors a move here towards the upside, and this is a clear sign that we want to exit the trade, because we only want to be in trades where the probabilities is on our side. But what about the target level right here? Well, when it comes to target levels, it's not as clear, you know, where exactly to set your target, and it can, you know, vary on a case-by-case basis. One method to place your target here is to set it just below the high of the uptrend. So right here we have the high of the uptrend. This is the high we need to break here in order to create the next break of structure and in order to maintain the uptrend. But sometimes, especially when we see such a strong reaction, you can see we have a very strong reaction, very large bearish momentum candles. In these cases, many times this point right here can actually act as resistance, and it's possible that we can see some sort of double top at this level. So locking in profits just before the high can definitely be a valid strategy. Another method you can use here to set targets is to use a fixed risk to reward ratio. So what do I mean by this? Well, a fixed risk to reward ratio, a very common one, is a 2-to-1. And this basically means that the reward you get from the trade is twice as much compared to what you lose if you lose the trade. So by using a 2-to-1 risk to reward, you don't even have to be right half of the time, because every time you will win twice as much. And last but not least, a third method here is to use the measured move we talked about earlier in the course. In this case, the impulsive move was this move right here. So we can take this measurement right and measure here from the start of the next impulse move to get our target. So now the next trading strategy I want to take a look at is the pullback trading strategy. And this right here is, you know, a trading strategy that all traders need to know about, in my opinion. It's one of the most common and one of the, at least in my opinion, one of the best trading strategies, because by trading pullbacks, we trade in the same direction as the trend, and we aim to enter at a point in the market where we can catch the next impulsive move of the trend. And remember, impulsive moves are these strong moves that goes in the same direction as the trend. So this can often be a favorable position to enter in the market. But before we dive into the charts here, let's take a look at some brief overview of the pullback trading strategy. And as I already mentioned here, pullbacks are one of the most important structures and one of the most important patterns in trends. And here, when it comes to pullbacks, we have many different patterns and names for pullbacks. For example, we have structures called flags, we have, pennants, wedges, and there are tons of different specific variations of pullbacks. And while it can definitely be a good idea to learn about all of these different pullback patterns, the fundamentals of all pullbacks are actually the same. So for example, a pennant is a pullback that looks maybe something like this. So right here we have the pennant, while a flag is more of a structure that looks maybe something like this right here. But the principle of both of these patterns are the same. We have an impulsive move, then the price pullbacks, cools down for a bit here, and our goal here is to catch the next impulsive move. What is the setup here for the pullback? Well, what we're looking out for here before we trade the pullback is that we want to see a strong momentum move before the pullback. So the impulsive move before the pullback appears, we want to at least preferably be, a very strong move here towards the upside. And when it comes to the entry or the triggers for the trade, so what signals are we looking out for here to enter, we have two main different ways to enter. The first way to enter is to enter the trade by buying near support in uptrends or selling near resistance in downtrends. And by buying near support, I mean that we're trying to buy near the support of the pullbacks. So for example, trying to enter right around here. But we also have another entry trigger, and that is to enter by buying the break of the resistance or break of the support. So in the case of an uptrend, this is when we enter where the price breaks above the resistance. An example of this can be found right here. And what about the stop placement? Well, in most cases, we want to place the stop loss below the low of the pullback. And many times, in this case, I often like a wider stop loss compared to the failure test pattern. The failure test pattern is a pattern where, if the price just slightly dips below the wick of the pattern, we want to exit the trade right away, because that is a clear sign that the market is not behaving as we, thought it would behave. But when it comes to pullbacks, we can actually allow for a wider stop, because many times it's hard to determine how deep a pullback will actually be. So it's possible that we enter and we get another counter trend leg against the direction of the trade, but this can still be a valid pullback. So at least in my personal opinion, I like a little bit wider stop loss when it comes to pullback trading compared to the failure test pattern. And what about the profit target? Well, for the profit target, we have mainly two different methods. We can use a measured move objective that we have been talking about earlier in this course, or we can use a fixed risk to reward ratio. But you can also, of course, use more advanced methods. Many traders will use different kinds of price action signals that tells them that, this is a trade I don't want to be in anymore. So they can basically use discretion to exit the trade. So now let's just take a quick look at the pullback trading strategy here in a real market. We're looking at the Australian dollar, US dollar on the 15-minute time frame, but pullback trading strategies you can use in pretty much all markets, pretty much all time frames. The only recommendation I can have here is, make sure that you're trading something that has sufficient liquidity. So trading pullbacks in very small altcoins where you don't have a lot of buyers and sellers can many times be more risky than trading it in, a larger, for example, a forex pair or a larger cryptocurrency like, for example, Bitcoin. But now let's analyze this chart right here. The first thing we can notice about this pullback is that before the pullback appeared, we had a very strong impulsive move. We had a very strong trend leg, and that is a good sign. And then we actually, right here, we saw the actual pullback appear. And remember from earlier in this course, I talked about some signs we're looking out for in pullbacks. One sign is that we're looking out for mostly small candles. And as you can see right here, we have mostly small candles. And we're also looking out for candles with different colors. So we want to see both, preferably, you know, both red and green candles. You can see that we also have right here. We also have multiple wicks, which is yet another good sign. But what about the entry here? Well, let's talk about both the entries. So one entry point is to try to enter at the support. And in this specific pullback, I do think this right here was the best entry. Because first of all, you can see that the wick of this pattern just taps the support here. You can actually also use the failure test strategy where the price quickly dips below support and then pushes above. Then you can use the sort of failure test entry. You enter at the candle close that closes above the support and you set your stop loss below the wick. But it's also possible to enter here when the price just taps the support. Another thing that I like about this entry was that this candle right here was actually a hammer pattern. It was almost like a dragonfly doji, which in itself is a bullish pattern. So that can slightly improve our chances of success. So you can enter right there. Let me just, you know, do an example of an entry position. So use our long position. Let's say that we enter at the candle close of this candle. Then I would probably set my stop loss somewhere around here. As you can see, I leave, you know, a wider stop loss. And why do I do this? Well, because then we can allow for the price to go up here and continue the pullback and perhaps bounce off that low before the next impulsive move. So if we leave some wiggle room, we can, you know, extend the possibility of, we can, you know, allow for the possibility of the pullback being extended here and still not be stopped out. I hope my, you know, language is not confusing right now, but this is basically the reason why I prefer a wider stop loss when it comes to pullbacks compared to failure tests. And as for the profit target, as we talked about, we can either use a fixed risk to reward ratio. So a risk to reward ratio of 2 would simply look something like this. You can also try to catch wider moves by doing the whole measure move. So you measure the move here before the pullback. So we measure all the way from low to high. We take this measurement, measure from the low right here, and I'm not even sure this trade would succeed. Well, in this case, you can see that the uptrend actually continued, so we would have locked in our profits, but this would have taken quite a bit of time. You can see the uptrend continued, we consolidated here for a while, but eventually the uptrend continued and we reached our target. The other entry method here is to enter at the break of the pullback. And when we enter at breaks, what we're looking out for is actually pretty much exactly what we saw right here. We want to preferably see a strong momentum candle breaking up to start the next trend leg. And in this case, you can see that we had a strong momentum candle breaking above. The common entry point is to enter at the candle close of this candle right here. And when it comes to stop losses for the breakout, you can once again set the stop loss below the low of the pullback. In this case, you can have a tighter stop loss compared to the low we have right here. So you can have it pretty tight. And once again, for the target, you can use a fixed risk to reward. Perhaps a 2-1 would be the target up here. You can see we eventually reach this target, right? But you can also use the measured move objective strategy. All right, guys, so this course is actually coming to an end very, very soon. So I want to thank you all so much for watching. If you like my work and what I do here on the channel, and at the same time want to get access to some exclusive content, please consider becoming a member of the channel. I want to give a big shout out to our recent channel members. You guys are the official sponsor of the channel. And also, of course, if you have any questions about this course or anything else, please don't hesitate to drop a comment down below. And last but not least, when you are ready to continue your trading journey, I highly recommend checking out this playlist. It contains all of the educational trading courses I have made so far, and more is coming very soon. I hope you will have an awesome day, and I hope I will see you guys in the next video.